You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to an all-new episode of OIC's Wide World of Options. I'm your host, Mark Benzaquen. For February, we'll be highlighting the Greeks, which are key pricing factors that can help investors make sense of their risk and option values. And to help us make better sense of these concepts, we're off to the Great White North with a stop in Toronto, Ontario, to visit with Ankit Mehra of Mehra Wealth Management and CIBC Private Wealth Management. Ankit, thanks so much for joining us and welcome.
Thank you so much, Mark, for the opportunity.
Ankit, again, I appreciate you joining us, so thanks so much. Let's go ahead and start at the beginning. When it comes to new investors, and that's typically our focus here at OIC, those new to options. So when it comes to new investors, how would you summarize to them the concept of the Greeks in the sense of, as a generalization, how do you explain the concepts of what the Greeks are and how they affect investors?
Absolutely. With the option Greeks, in essence, they're like a crystal ball for option trading. I mean, it's always nice to know where the markets will be in the future, but no one really has that crystal ball ready. But they, in a way, allow for an investor to position for what the future could look like because they provide information on what the option value could look like based on a set of assumptions. Now, Greeks estimate future option values based on a small change in stock price, time, volatility, and other factors. And the five main Greeks are Delta, Gamma, Theta, Vega, and Rho. And they help us get a general understanding as to the risks involved in the option position. So I guess the main takeaway there is that they provide us with a crystal ball for foreseeing what may happen in the future and how we could respond to that.
Right. One of my colleagues here at OIC likens the Greeks to kind of like the dashboard in your car, where you've got all of the gauges and it's showing you, oil levels, your speed, et cetera. And one of the things that he likes to say is you don't have to stick your head out of the window of your car to know how fast you're going. And the Greeks are kind of the same way. They give us this overarching idea of how our position might fare based on any of those changes that you had mentioned, stock price volatility, et cetera. So excellent. Thank you for that. Let's go ahead and look at that first one. You had mentioned delta. Now, delta is something that most people consider as a Greek that has kind of two ramifications, one of which being how much our option might change with every $1 change in the underlying price, and also the probability of that contract finishing in the money. So when it comes to delta, what's your take on that? How do you look at delta?
Absolutely. So the most important thing with delta, as you rightly mentioned, is it responds based on how the underlying stock or the underlying asset is moving. So normally, as far as in the money is concerned, or even if we consider multiple factors, we normally like to consider things independently before we look at how different factors would respond with delta. So delta on a standalone basis, let's say if a stock price were to go up $1 and a delta is 0.5, then we would expect the option to move up by 50 cents. That is on a standalone basis, but we know that in the world, it's not just delta alone that is moving the price. There's so many other factors that are involved, whether it's the time value, whether it's the volatility in the market. There could be a gamma as well. So if we look at it on a standalone basis, then delta basically shows us how the option would move if the stock price were to move, just based on that first derivative.
Yeah, and you bring up a good point, the standalone basis. When we look at the Greeks, we kind of look at a snapshot in time, right? This specific moment is how your option might change with, as you had mentioned, the $1 change in the underlying price. But there are other factors moving. There are more moving parts than just that stock price. So, yeah, I'm glad that you brought that up. It is just really a snapshot at that moment in time.
Absolutely. I mean, there are many different complex ways to look at it, but the easiest way specifically would be if we look at things on a standalone basis and see how in different scenarios how things would respond.
Yeah. And what about so delta is going to be that expected change in the option value based on a $1 move in the underlying, and that's generally the agreed consensus or agreed opinion that most people have as to the definition of delta. What about the other one that I mentioned, probability of the option finishing in the money? What does that mean to investors?
Right. So probability of the option moving in the money, there is a factor of time which comes into play. So the closer we are to the expiration date, the less time that we have till that option matures, that has an impact on the delta overall. So for example, if the delta is 0.5 for an option, which is 2 months out, but then all of a sudden, if we're looking for shorter term options, which are a month or even 2 weeks to maturity, then in those cases, the delta can be impacted. Instead of 0.5, it might be 0.4 or 0.3, just given the fact that the probability of the stock closing in the money by that period, given that decay in time value or less time value, would automatically be impacted. As I mentioned, many variables do come into play when we're comparing how they would respond. But as far as delta is concerned, it would move basically with the options, and as they move more and more in the money, then at that time delta is fairly close to 1, and it's moving with the stock or the underlying security.
Mm-hmm. Right. And the higher the delta, the more correlated that option value is to the stock price. So the higher delta, that option value is going to move closer to, as you had mentioned, 1 than, for example, a lower delta out of the money option. Another thing that you mentioned in terms of time, when we're trading options, and particularly when we're buying options, we need something to happen, right? We need the stock price to move up. We need implied volatility to change, something like that. We need something to happen within that time frame that we have until the option expires. And the less time there is, the less valuable that option is, because we've got less time for what we need to occur to actually occur. Another thing that we look at delta is people equate it to the speed at which our option value is going to change. If we have an 80 delta, that option is going to move 80 cents for every dollar that the stock increases. If we have a 20 delta, it's only going to move by 20 cents. So some people look at delta as the speed at which that option is going to change. And that leads me into the next topic, which is gamma. A lot of people look at gamma as the acceleration. If delta is the speed, gamma is the acceleration of that change. So if you would, take us through gamma. How do you explain that to investors?
Absolutely. So gamma specifically mentions how delta would change based on the move in the price of the underlying asset. And that's a great example. It's basically the accelerator on that dashboard.
Right.
So going back to the original example, if a stock were to move $1 and the delta is 0.5, then naturally the option would be moving by 50 cents once the stock is moving up by $1. But gamma specifically shows how delta would change if that price change were to happen. So gamma, let's say, could be 0.05. So if the stock price were to move $1, in addition to the 50-cent move on the option from the delta, the gamma would also shift that delta higher because that stock has moved $1. It would also move the delta from 50 to 55 because it is basically the second derivative. It is showing how the delta would change as the price of the underlying is changing. Now, gamma tends to be highest when those options are at the money, and they tend to be lower when the options are moving further and further out of money.
Mm-hmm.
Now, to specifically explain that basically means when, the delta is more volatile, or it's higher when the stock is at the money or in the money. But if the option is out of money and delta is very low, then the delta is moving less, so which makes the gamma overall very low for out of money options.
Mm-hmm. Okay, excellent. Let's move on to the next one, theta, which I think is something that most people can, relatively easily understand. We were mentioning earlier, for example, when you're buying an option, you need something to happen within that time frame, and as that time frame shrinks, that option is going to lose value, and that loss in value we call time decay, which is represented by theta. So take us through that, if you would, please.
Absolutely. So theta is essentially, as you mentioned, it measures the change in the price of an option from a passage of 1 day in time. And theta tends to be negative, which basically means if an option is worth, let's say, $1, and then there's a month to expiration, for every single day that's passing, there's a theta decay. So if, let's say, theta is 20 cents, it's losing that every single day that is passing. So theta can be a friend for sellers, but it can be an enemy for the buyers, because
you stole
for buyers, they need to get two things right.
Yeah, you stole my line there. That's what I always say, a friend to sellers and a foe to buyers. So I'm glad that we're on the same page with that. Thank you.
Yes.
Yeah. Now let me ask you this. So you're saying, theoretically, if theta was 20 cents, that option is going to decay. That's going to lose value 20 cents each passing day. But that rate of decay isn't constant, meaning that for longer term options, that rate of decay may be very, very small. It might be fractions of a penny a day. But as we approach expiration, including on expiration day, that theta accelerates to where if that option is at or out of the money, theta is going to wipe out the entire value of that contract. Is that right?
That's absolutely true. And that's why when we're selling time or when we're buying time, the theta tends to be lowest for, as you mentioned, the longer duration options. The impact is not huge, but then if they're very short-term weeklies, these days they're talking about daily options,
right,
and monthly options, the theta tends to have a much widespread impact on the value of the option, which can make it very positive for an option seller because they're looking for that theta decay. Mm-hmm. But it can be an issue for the buyers who must ensure, who not just must ensure, that they may not necessarily be guaranteed that the stock will move in their direction in that small duration time, which which is why Theta can be an enemy for the buyers of those options because they need to get the direction right in such a small time period.
Right, right. And as you had mentioned, that the shorter that time period, as you've got a 30-day option, and then now all of a sudden a week passes by and another week, et cetera, that unless something else happens, as we had mentioned, unless the stock price increases or unless implied volatility changes, that option, which may have cost $1 at inception, is now worth 50 cents, or now it's worth a quarter, and it keeps eroding, decaying each and every day until there's nothing left, assuming that things don't go right. So as you had mentioned, buyers, something has to happen in order for that value to increase because they're fighting decay, that time decay, each and every day. Which, again, to me, it kind of makes it seem like the concept of time decay is more inherently maybe understandable by option buyers and sellers, because they can realize that, just like anything else, or I should say, just like many other things, an option is a depreciating asset. So each and every day it's going to be worth less and less unless something else happens to make it worth more. So good on that topic. Thank you so much. Next one, Vega. This Vega goes hand in hand with implied volatility, which for new investors is certainly a concept that I think might be over their head a little bit. So let's kind of look at this in layman's terms. Implied volatility, what is it? And how does Vega work hand in hand with that?
Right. So just starting with the implied volatility, that essentially reflects the market's view of the likelihood of a change in the stock's price. Now, it is derived from the option price and shows the expected volatility of that underlying asset. And higher implied volatility typically means higher option pricing, just given the fact that there's a higher chance or greater potential for larger price movements in the underlying when there's higher implied volatility. So as far as Vega is concerned, it's just specifically measuring the sensitivity of the option price to changes in the volatility of the underlying asset day to day. And as I mentioned earlier, higher volatility increases that likelihood of achieving, let's say, having those options reach at the money or in the money, which is why option premium tends to be higher in periods of high stress or high volatility in the market. If we have an impact, that's all of a sudden where you see that options inflate, even the short-term options, even the short duration options, or even long-term options. Vega tends to increase the option premium as there's more potential to make a profit if that underlying move does take place in the market.
Yeah, I know that there's I know that there's a saying that when it comes to the market, things slowly get more expensive, but quickly get cheaper in terms of market crashes, and because of that reason, you'll see a lot of people, and this is kind of an extraneous concept or tangent that I'm going on, but there's something called volatility skew, where more people are willing to pay more money for downside protection against market drops as they would be, for out of the money calls, for example. And what all that means in terms of Vega is that as that market uncertainty increases, right? Maybe as demand for option increases, implied volatility is going to increase, and that Vega is going to change simply because of that uncertainty. As Vega is higher, it means that your option prices are going to be higher with every change in implied volatility. If Vega drops lower, things are going to get cheaper, and it affects calls and puts equally, right? So it doesn't necessarily matter if you're talking about long calls or we're talking long puts or short options, et cetera. Vega affects all options equally. Isn't that right?
That's absolutely correct. It has the exact same impact for both calls and put options. It can increase Vega, so volatility increase can actually increase, or it can also decrease. If there's a decrease in volatility, then the premium collected or paid for calls or puts would change the same way, in the same direction of the volatility.
Right. last one. Let's talk about Rho. Rho is the option sensitivity to interest rates. It's generally the most overlooked Greek. And in my opinion, it's simply because interest rates don't change every day. Interest rates don't change every minute, right? Like stock price does. Or they don't change every day, like, time decay. So, days ticking off the calendar. Interest rates change seldomly. So for shorter term options, there may not be a change in interest rates at all throughout the life of that contract. Whereas a LEAPS option with maybe a 2-year maturity, obviously there's going to be several opportunities for interest rate changes. So if you walk us through Rho for a little bit and let us know how would you explain Rho to an investor?
Absolutely. So Rho, as you rightly mentioned, it measures the sensitivity of the option price to changes in interest rates. It doesn't have as much impact on shorter dated options, more so longer dated options and LEAPS, which are more susceptible to interest rate changes through time. Now, they tend to have more significant impact the longer you go, but at the same time, they treat calls and puts differently. For example, call options, they have a positive Rho because as interest rates rise, the present value of the strike price decreases, making it less costly to exercise the option in the future. And this increases the value of the call option. Whereas in the case of put options, they have a negative Rho. They're negatively impacted by a rise in interest rates. That's mainly because the present value of those strike prices is lower 2 years out or a year out for that option compared to today. And just to give an example there, if we have a stock which is trading at $100 today, the right to put that stock onto someone else a year later, 2 years, if we buy that put option, is a lot lower if interest rates are higher, which is why the time value of money comes into play in Finance 101.
Right.
So that's why put options have a negative Rho when interest rates increase, whereas call options have a positive Rho. And that's how Rho has an impact. But again, as I mentioned, mainly longer duration options, it doesn't really have much of an impact for short-term options.
Right. Excellent. Well, Ankit, thank you. This was terrific. I really appreciate your time. Thank you so much for joining us.
No, thank you so much for the opportunity, Mark.
Yeah, they're great. And ladies and gentlemen, that's going to do it for today's episode. I want to once again thank our special guest, Ankit Mehra of Mehra Wealth Management, live from Toronto, Ontario. So thank you for taking the time to sit with us today, and to all of our listeners out there for their continued support of our Wide World of Options program. Take care, everyone, and we'll be talking with you again very soon.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.